So I was reading the other day and I discovered that the average net worth for a 20-year-old in America is around negative $27,000, which means that they're actually in debt $27,000 more than they have in the bank. And honestly, I was in the same boat. If I'm being really honest, I actually had more debt than that just because of the amount of student loans that I had taken out up to that time. And aside from my really old car, which was like a 1998 Geo Prism, I did not have any assets to my name. Getting into crazy amounts of student loan debt is something that I wish someone had come to my high school and done a seminar on when I was applying to colleges, because having all that debt had a really profound impact on my future, to the point that to this day, I'm still paying off my student loans. And I've been out of college for longer than I'd like to admit. So that actually got me thinking about what are the 5 things that I wish that I knew about money when I was in my 20s. Number 1, just like I mentioned, it's avoiding debt. This goes for the 2 most common sources of debt for people in their 20s, which is credit card debt and student loan debt. Like I mentioned earlier, for me, my source of debt was primarily from student loans. Now, I'm not in any way saying not to go to college or pursue higher education if it means that you have to take out some loans. Data has actually shown that having a college degree increases your earning potential versus having a high school diploma. But I really encourage you to look at the options out there for reducing student loan debt. Maybe you could go to a trade school, maybe go to community college for a couple semesters before going into the 4-year college, or even going to an in-state school versus a private university, and also applying for every scholarship under the sun that you qualify for. I had also racked up a little bit of credit card debt towards the end of my 20s. I actually read that people 18 to 29 account for like $52 billion. $52 billion? Of credit card debt in the United States. Everybody says, open a credit card. You want to start your credit history. You want to build your credit. And I do think that's a good idea to open a no-fee credit card when you're younger and use it responsibly to help build your credit history. But the issue is that younger people are not always the most responsible when it comes to money. So it's easy to fall into this cycle of overspending on your credit card and then not being able to pay off the balance every month, and then just constantly carrying this balance on your credit card that you're also paying pretty high interest rates on. If you are going to open a credit card, I really recommend putting a couple of small expenses on there every month and then just paying the balance in full so that you're never having to pay interest. And over time, paying your balance in full and paying your credit card on time every month will have a very positive impact on your credit score. If you do have debt in your 20s, pay it off as aggressively as possible, and do not defer your payments unless you absolutely need to. When I was in grad school, I actually deferred my undergraduate student loan payments because I was in school full-time, I was working part-time, I really didn't have a lot of income. So when I saw that my loan service provider offered this thing called deferred payments, which basically meant that I was able to not have to make any payments on my undergraduate student loans and I wouldn't get penalized for the amount of time that I was a student, that seemed really attractive to me. But what I didn't realize, or what I guess realized but didn't understand the impact of, was that when I wasn't paying on the principal of those student loans, they were just growing and growing and accruing interest while they were just sitting there. So by the time I finished grad school, my student loans from my undergrad had actually grown to more than I had originally borrowed, just because they had been sitting there collecting interest. As difficult as it may seem, you really want to just start paying your loans as soon as you can and keep on paying them. Even if it's just a little bit, your loan service provider will usually offer something called graduated repayment plans or income-based repayment. And that means that you can adjust the amount that you owe every month based on your income, which is really helpful because then at least if you're not making as much, you can pay a little bit less. And then as you start to make more money, you can pay a little bit more. And I do really recommend putting a little bit extra towards your student loans every month if you can afford it. So if we look at the average $27,000 of debt that the 20-year-old has, and let's assume that that's all student loan debt. So let's assume you've taken out this loan and you're paying it back over 10 years, and the loan has a 5% interest rate. Your monthly payment would be $286.38. And over the lifetime of that loan, you'll have paid $7,365.23 in interest. If you were to add just an extra $100 to your loan payments every month, you'll not only have paid off your loans faster, but you'll have only paid $4,978.34 in interest. So that's almost $2,500 of savings. Number 2 is understanding the power of compounding interest. Essentially, it's interest that accumulates on an amount of money. So when I talked about my student loan debt growing to a larger amount than I had originally borrowed, it was because the debt was continuing to grow and earn interest while I wasn't paying down the principal. The reason compound interest is so important to understand is because it works against you when you have debt, and it works in your favor when you have investments. So let's look at an example of $100 that you put into a savings account. And let's say that that savings account earns you 5% interest. At the end of the first year of having that $100 saved in your account, you'll have $105 because you'll have earned $5 of interest, because 5% of $100 is $5. At the end of your second year, your 5% interest is now working on the $105 that you had from the previous year. So now when you're getting your 5% interest, you're actually getting 5% of 105, which is a slightly larger balance. So now the interest that you've earned is $5.25. And I know it might not seem like 25 cents extra earnings is that much, but when you think about it on a greater scale of money saved over your lifetime, it really has a super important impact. So that brings me to the number 3 thing that I wish that I knew about money in my 20s, and that's the importance of investing early. There's a saying that I really like that goes that time in the market is more important than timing the market. And basically what that means is don't try to pick the right time to start investing. Just start investing as early as you can, and then just let time work in your favor to allow the money that you've invested early on in your life just grow and compound throughout your lifetime. So let's look at this example of compounding interest with some more substantial numbers. If starting at 25 years old, you invest $6,000 a year, and I know that that might sound like a lot of money, but if you break it down to monthly payments, it's $500 a month. So if you invested $6,000 a year every year from the age of 25 to 55, assuming a 7% return on investment, which is historically what the stock market has returned over time after you account for inflation.
Okay, so let's take a look at this example of saving $6,000 a year from the age of 25 to 55. So 30 years, we're expecting 7% return, and we're contributing $6,000 every year. So you can see that we've got $566,764. So we've contributed $180,000, and we've earned $386,764 in total interest. Now, if we were to wait just 5 years to start investing, and instead of investing from the age of 25 to 55, we were to start at the age of 30. So now we have 25 years to invest. We're getting the same 7% return, and we're contributing the same $6,000 every year. So our ending balance is $379,494. So our total contributions are only $30,000 left because we've put in $150. But now our ending balance is almost $200,000 less just by waiting 5 years to start investing. So you can see how important it is to start investing as early as possible.
That's a significant amount of money that you could have potentially earned, but that you didn't get because you waited 5 years. But that's the power of compounding interest. And I understand that it might seem like you can't afford to start investing when you're younger, especially if you're not making as much, or you think that maybe it's better to put all your money towards paying down your debts. And For some people, that is the case, and it kind of depends on your situation. And I understand that investing can seem really scary or risky. I truly believe that it's something that everyone can do for themselves, even if it's just as simple as having your work take $500 a month out of your paycheck and contributing that directly into your 401k, or taking money and putting that into a Roth or a traditional IRA, or even just putting it into some sort of index fund. If you have no idea how to get started investing, go ahead and like this video and subscribe to my channel, because I will be posting a lot of videos in the future that go over all sorts of different investment strategies, ways to build your wealth, ways to earn more, and ways to really just take control of your personal finances. So number 3 is the power of negotiating your salary. When I finished grad school, I was entering a completely new field of work than I had worked in previously. So I really didn't have a lot of leverage to negotiate when I was applying for jobs. So I basically just took the first job offer that I got. So I ended up settling for a salary that was about $10,000 less than I wanted to make. But I didn't really have a lot of options because, I had a lot of debt and I really needed the job. What I didn't realize then is the power of negotiating your salary early on in your career. And the reason this is important is because every time that you get a promotion or a raise, it's usually based on a percentage. So let's say your job gives you a 2% raise every year to keep up with cost of living and adjust for inflation. So if your salary is $100,000, you're getting a $2,000 raise. And if your salary is $50,000, then you're getting a $1,000 raise. The next year, if you were making $100,000, your salary would be $102,000. So then when you get the next year's 2% cost of living increase, you're getting a $2,040 raise. And on your $51,000 salary, you're getting a $1,020 raise. And I know, no one's negotiating their way from a $50,000 to a $100,000 salary. And if you are, give me a call, because I need to know how you did it. But let's go back to the example of even just negotiating a $10,000 difference in your salary. Let's say you get a job offer and they say that they're willing to pay you $50,000 a year. If we look at that $50,000 starting salary over a 30-year career, and all you get is 2% pay raise increases every year, then at the end of your 30-year career, your salary would be $88,792. But if you were to negotiate your starting salary from $50,000 to $60,000, then over that same 30-year career, again, assuming that all you get is the 2% cost of living increase every year, then your ending salary would actually be $106,550. If you add up all of the money that you would have earned over that 30-year career, that comes out to a difference of over $400,000. Now, hopefully, if you're good at your job, you'll get a couple of promotions along the way. And let's assume that each one of those gives you a 10% raise. Starting at that $50,000 salary, your ending salary would be $129,520. Starting at a $60,000 salary, your ending salary would be $155,424. Over the course of your 30-year career, you'll have earned more than $500,000. $500,000. So that's why I think it's really important when you are getting a job, whether it's your first job at a college or if you're switching jobs somewhere along the way, it's really important to just negotiate your salary. No one's going to think that you're greedy by asking for more and then take any job offers away. It's just a part of the process of getting a new job. And honestly, most recruiters that you talk to are going to expect you to negotiate a little bit. So don't be afraid to ask for what you want, because it really can have a big impact on the amount of money that you earn over your lifetime. Number 5 is having a basic understanding of investing. I understand that managing finances can seem very scary and confusing, and for a lot of people, it's still really taboo to even talk about money. Almost no one learns about taxes and finances in high school, and unless you study finance in college, which, full disclosure, I didn't. So when I became an adult and was responsible for my own finances, I had no idea what I was doing, and I made a lot of mistakes along the way. I had no idea the different kinds of retirement accounts that existed, what were the pros and cons of each, how are they similar, how are they different, what did it mean in terms of taxes. And because I didn't know about these things, I wasn't able to take full advantage of all of the benefits that utilizing these accounts can give you when it comes for saving for retirement. So if you found this video helpful, please like and subscribe, because I have a lot of really good information coming on how to save money, how to invest, how to pay off your debt, and just overall strategies for building your personal wealth so that ultimately you can live your best life possible. If you have specific topics, please leave them in the comments below. Until then, I'll see you next week.